I'm Peter Resnick from ShadowTrader.net, and this, of course, is the Weekend Edition. Good to be back with you again on these Friday afternoons where we talk markets from a technical perspective. Today's show is going to veer a little bit more into the fundamental, which, as the markets have been kind of crazy lately, you'll notice that I've been kind of veering off just a little bit more into the fundamental than I have usually. And I thought specifically this would be a good video to discuss the topic of stagflation, because it's something that I see coming up more and more as I'm, surfing the web, reading articles, etc., social media, whatever. This concept of stagflation seems to be coming up because there is a fear that current economic policy is going to push America into stagflation. So we're going to spend a moment just basically defining what it is, how it works, and most importantly, who are the winners and losers in a stagflationary environment, right? Beyond that, I'm going to do something this week called Play of the Week. I do this segment sometimes where I'll take a trade that I've done in the past week and analyze it, but this one's a little bit different in that the play of the week is actually going to be all the plays that I've done in all of 2025. I'm going to show you what the weekly options room that I run has been doing since the beginning of the year up until now, and I think you'll be a little bit surprised to see that what I'm doing actually with my subscribers, which is of course a direct reflection of everything I'm doing with my own money, is not really always 100% aligned with these videos. Just to remind you that, remember, I only get to speak to you once a week, and this market moves and shifts a lot. And more importantly, this market right now is not really trending at all. There's a lot of sideways action. There's a lot of back and forth, a lot of one day up, one day down, etc. And that, of course, is a little bit problematic. So that also is going to be reflected in what I'm going to show you, in that we're trading lighter, we're kind of stepping carefully, and we're basically picking our spots as carefully as possible. And it has worked out very, very well for us. And I think just in that, there is a lesson to be learned, because that is one of the most important things that you can do as a trader, is to know when to take your foot off the gas and when to go full throttle. All right, beyond that, we'll do our usual tour through the major averages charts, lots to talk about there. And of course, I've got a #1 draft pick to share with you as well. All right, so without further ado, this is the Weekend Edition. Let's get into it. Okay, as always, let's just do a little tour through major averages and 11 sectors of the S&P and other important instruments in our week in review. Always calculating from the Monday open. A little bit of a shortened week this week. It's only been 4 trading days. I'm speaking to you on Thursday today, obviously, instead of Friday. And the S&P was down a bit, and we're going to talk about that in a second, especially in relation to last week's video. That's why you'll see, as you get deeper into this video, you'll understand why I'm doing this week, because of my bullish sort of outlook last week, which didn't really play out. We didn't fall too much yet, but we did definitely come off. I mean, the S&P is down 3% over the course of the week. NASDAQ is down 4%, and the Russell's been kind of holding its own a little bit, down about 0.5%. All sectors, as you can see, pretty much negative. No big surprise there, with XLK bearing the biggest brunt. Similar to last week, I talked about this, where you see tech kind of aligned with the NDX. That's obvious. And notice that it's down 5 2/3%, and kind of tying in with what the NDX is down. And then over here, it gets interesting. I call this kind of like the back end of the S&P. These are the sectors that have far less weight. Potentially, some of them are defensive. And, staples still outperforming a bit. I mean, up 1.5% over the course of the week. Consumer staples. Energy had a decent week because crude had a little bit of a rebound off some recent lows, and utilities had a decent week, and so did real estate. Materials kind of flat to down. So that's interesting to me, in that you're starting to see some green shoots there. And again, that kind of speaks a little bit more towards the two-sided nature of the market over the course of this week. Bonds were about flat. 10-year yield backed off a little bit. VIX continues to collapse, which is kind of a bullish sign in the near term, I would have to say. Gold continues to outperform. That trade is still a rinse repeat for me, as I've been saying over and over. Sell puts in the GC futures contracts and look for pullbacks to buy the GC futures contracts. Oil up a bit, as I already said, had a little bit of rebound, and Bitcoin was up about 1.5%. Remember, Bitcoin is still going to trade as a risk asset. Facts. It's not going to be off by itself. So pretty much whatever you're seeing in the markets, I know it's a little bit opposite this week, but more than likely, I don't think you're going to see a larger move to the upside in Bitcoin until you get some sort of traction in equities. But essentially, that's the week in review, what's happened. So like I said, just a little bit down. And when we get into the charts, you'll see a little bit more contextually what has happened in relation to the majors being down this much, and where we are more on a technical basis, which of course is the most important thing. Remember that most traditional media does not rely on any charting whatsoever, and they're just going to talk about these types of numbers, but this really does not tell the tale. So when we get into the what's really going on section, you'll see much clearer as to what's really going on specifically with the majors and the sectors and where we are right now. Okay, time now for the play of the week. Usually we'd be rolling into what's really going on right now at this part of the program, but I decided to put this a little bit first because it really sets the tone and gives us some runway into what we're going to discuss about the nature of the charts in the broad market when we get to that next segment. So what you're seeing here on the screen basically is every trade that I've done in my weekly options room with live money, all time stamped, all managed fully in real time. 144 trades since the beginning of the year. This is just a piece of the P&L. The P&L is, of course, spanning many, many years, almost always at the high water mark for profits pretty much every month, knock on wood. And this is the last 144 trades, which down here, they're not dated, but down here is January 1st, is the beginning of January. And this is where we are right now. You can see the last trade is open. That's actually all I've got open right now is some short puts on GC futures contracts of gold that I've been doing for a little while. So a couple of things should jump out at you here. And I specifically put the last two videos up right here just to kind of put into context of what I talk about on the weekends versus what I actually do. Because remember, I'm a very short-term trader and the market moves and shifts constantly, and what I say on a Friday afternoon in terms of bias may not be exactly what is happening in the next week. And regardless, I am constantly moving and shifting so that I can be in sync with the market. And that is often, like I said, not reflected in what I said in the videos. So I just put up the last two videos. Last week I said doom's over, the smart money is buying. Not so much this week, right? Like down like 4% in markets. But again, when we get to the charts, I don't think we're falling apart just yet. I think this actually may prove to be true. We shall see. And then, of course, the week before that was the market bottom here. And that actually was a perfect call because if you go back, you'll notice in that video that it was the bottom of the market. But going back to this right here, you'll notice that there have not been, even with all the chop, I would say like these last 2 weeks have had just insane chop. I mean, especially given the day in early April where the tariffs were put on pause, the market moved up 11% from the lows in one day. Again, 11%. I mean, this is absolutely unheard of to move that much in one day. And that definitely threw us for a loop right here with this QQQ. This is one of the losing trades. There haven't been many. I just want to also point out of these 144, there's only been 6 losers. 144 trades, 6 losers. Now, obviously, you may look at this very briefly and say, well, wait a minute, I see a lot more red numbers than just 6. Yes, but I'm not counting the tiny ones because it doesn't really matter because they're more of just like a scratch, right? Like, look at how many are like 20 bucks, 8 bucks, 54 bucks, 40 bucks, 8 bucks, $2, 47. So anything that's under 250, I don't count really as a loss. And there's only one trade here that even came close to like 244. So really the only ones I'm counting are these like larger ones here. And of those, again, there have only been 6 of those losses since the beginning of the year in all of the trades from January until now. And the focus here, I think, has to be on this section right here, because these are the trades that you see here that are within the range of when the videos came out. And again, whether I'm right or wrong on the weekend, the main takeaway from this is that there is a track record here that is overwhelmingly positive, and there is a track record here that does not get in trouble when the market is sideways, because specifically what I do is keep myself aligned with the broad market at all times, no matter what. That's my number one law. A lot of people ask me, okay, what's your MO? Like, how do you do what you do? And I always point them to this document that I wrote, which is available to all my subscribers. It's called the Weekly Options Playbook. And that playbook, basically, the whole first couple pages is me just laying out what is my theory on how I believe the markets work and how I approach them. And the starting point is always the broad market. I'm a huge, huge believer that almost all stocks will just follow the broad market, given there are always outliers. There's going to be earnings, there's going to be news, there's going to be pockets of relative strength and relative weakness. But honestly, it's like 85 to 90% that if the market is up, your stocks are going to be up. And if the market is down, your stocks are going to be down. And therefore, it really serves you well to always be in the direction of the broad market and never, ever trying to fight it. And right now, I believe we've got a broad market, as I'll show you in the next segment, with proof positive from the charts, because really those are absolute facts in terms of what's been happening there. There's not opinion that this market is really difficult and it's not really going anywhere. And this here, all the performance that you see really points to a trader, myself, that is not exposing himself very much to directional risk, is really just kind of taking some shots here and there, being very, very careful. And when the tide turns, getting out of stuff. Like, one of the ones that really kind of jumped out at me recently was the fact that I was bullish on the market. And this was this SPY right here. And I'll be the first one to admit that the market just literally fell apart, right? It wasn't actually that SPY. It was actually this one here, 1885. I apologize. This was a bullish butterfly trade on the SPY. And the market completely just fell apart. It didn't go anywhere. And yet the trade turned a profit. Why? Because selection of the type of structure that it was. Butterfly is always easier to manage than straight vertical or straight call. And also knowing when to get out and just bail on things when the market is not doing anything, and really just not playing that hope card. This is the thing that a lot of options players get hurt by, and especially weekly options players get exceptionally hurt by, because they don't understand the concept of just bailing out or not doing anything, and also being very, very aware of how weekly options cut both ways, in that, yes, you get a lot of bang for your buck in a short amount of time. You can buy something on a Wednesday and have huge expansion of that spread by Friday or whatever. But if you are laying out debit for that, which I don't like to do, but I would certainly do that sometimes, if you're laying out debit for that and it doesn't go your way and you're just playing the hope card, you're looking at a 25, 50, 75%, 80, or even 100% loss of that debit that you paid. And that's just going to put a dent in your P&L when you have those types of trades. So I try to avoid that at all costs. And that's why this has been working out pretty well, even in a very choppy environment. And I specifically wanted to show you this particular week. This is not something that we do that often on the program. But this particular week, I felt it was very important, because I know, as well as all of you know out there, how tough this market is right now and how it's just going a lot of back and forth, and there's really no specific trend to it, right? And again, when we get into that, what's really going on, I'll show you specifically why I say that this market is just straight sideways. And intraday, those of you who have been watching very closely, you'd have to admit there is a lot of push-pull here, right? You're constantly getting market that is surging higher, giving it all back, cracking lower, giving all that back. It's a lot of two-way action. And so we're kind of holding our own in that. We're waiting for some fatter pitches, I think, to develop, for lack of a better word. And when we get a little bit more trend, we'll get a little bit more active and obviously put more trades on. Right now, we've been kind of holding back a little bit, 2 to 3 trades a week. Usually we have 6 to 8, sometimes 10 trades a week. But this is the environment that we're in. A gentleman in our room hit me up this morning and put a comment, and I just wanted to end on this note because I feel like it crystallizes perfectly what I'm trying to say to you. And this was a gentleman named Joe this morning. And he very succinctly said, I just have to say, despite the craziness that we've seen in the market the last while, my trading portfolio P&L, driven mostly by this advisory, has had 2 of my best months ever. Awesome. I'm so psyched for you, Joe. My investment portfolio is getting crushed like everyone else. That's facts, of course. But a consistent string of nice little chip shots each week is making me good money. So I appreciate that very much, Joe. Thank you so much. Thank you for your support. And again, I just wanted to end on that note because he really just kind of crystallized what I'm thinking here, basically, is that if you're just smart about approaching the markets and be very, very careful, you can make money in this market. It's just a question of not exposing yourself and understanding when there is trend and when there is not trend, and acting accordingly. So if you'd like to follow me, I'd love to have you. $7 trial, always available on our site. You see the link down here in the Chiron, shadowtrader.net/options. That's also in the description of this video. As always, all of the $7 trials on our site, be it to my room or the live trading suite, always a one-click cancel. None of this BS of like you got to call us or whatever. One-click cancel. You know, if it's not for you, no problem. After 4 or 5 days or whatever, as long as you quit before the 7 days, you won't get charged. You'll just get charged $7 and we'll part as friends. So I hope to see you there. And I'm usually live in the room every day for the first 2 to 3 hours trading live, but then I'm also available for questions and comments for the whole rest of the day as well. But always those first 2 to 3 hours are absolutely live with me on the mic, sharing my screens and doing all these trades live with my subscribers. So I hope to see you there. Okay, time now for what's really going on. Of course, what I think is the most important part of the program, where we break down the major averages from a technical perspective. And we came off a little bit this week. We did not rally like I thought we would last week. I guess we rallied a little on Monday, right? Like we gapped up, but we came down. And since then, it's been this sort of bleed lower. And where that is leaving us right now, I think, is kind of in a little bit of a no man's land. I'm going to start with this SPX daily here. And one of the things that I recall speaking about this week to my subscribers was, regardless of what you use as signposts, as long as they're legit, right? Meaning like a 20 period simple moving average is legit, a 50 simple or whatever. Things that will have some reaction at, things that other people are watching so that they become some sort of self-fulfilling prophecy. It doesn't matter specifically what your signposts are, but you have to have signposts because you have to create a framework for your TA as a starting point. That's super duper important. So for me, I keep my TA as simple as possible. As you know, I'm a huge proponent of trend lines, support and resistance, and only two moving averages, 8 and 21 exponential, and that's it, right? You'll notice that I've never shown you a chart with RSI on it or any spaghetti stuff or any sort of all sorts of indicators and this and that. I don't do any of that stuff. I'm not an indicator person. I don't like any of that stuff, except for the few, of course, that we've developed for the market internals, such as weighted AD, iceberg tick, etc. But those are not indicators that you would put underneath a stock. Those are measurements of market internals, of strength under the hood, if you will. So anyway, S&P daily. First thing to point out right off the bat is, and again, talking about these signposts, right? It doesn't matter what it is, but you have to kind of pick something and stick to it so that at least you have a measuring stick to use with what you're doing. For me, that's the 8 and the 21. And notice how their trajectory now is just kind of sideways. I mean, it's a little bit still down here in the 21. This is the 21, is the blue, and these are exponential, and this is the 8. And the 8 is definitely sideways. I mean, it really hasn't moved in all these sessions here. Once we had this big turnaround here on the tariff suspension, this is the April 9th move where I was saying this S&P moved 11% from low to high. Since we got that, notice that the 8 EMA is absolutely sideways. So right off the bat, that tells you a lot about the market. It's just not moving. And we've got this uptrend line here that's, for the most part, holding, sort of. It's kind of now morphed into a correction by time and not price, right? Like the trend line on Friday's or Thursday's action, I should say, today was the end of the trading week, didn't really hold, but it didn't really break down either. So a couple of key points that I'm going to be looking for next week is I want to see if this double bottom here is violated. I think that the Wednesday bounce at the end of the day happened only because there was support here from this prior day. So I want to see if that happens. And then I want to see if we can close bars above these levels. And that really is the only thing that's going to change the tone for me. Until I see that, I really don't want to be committing too much to the long side on this market. But if I do see that, I do believe that some commitment is warranted because there's going to be a lot of short covering. Remember, you want to put yourself in a situation of trading in the direction of where the most amount of people are going to be surprised. And I believe they're going to be surprised by this because, as I keep saying, the headline risk is constantly out there. This is the wall of worry that the market is climbing. And markets, or I should say traders out there generally, do not want to make commitments when they fear that there is headline risk, right? When is the next shoe going to drop? What will the president say? Will there be a tweet? Will there be a change in tariff policy, etc., right? So you get buyers that are very, very tentative and hesitant, but that generally is the environment that leads to higher prices because at some point what happens, they throw in the towel and either become new money buyers or old business covering shorts, which is a form of buying in and of itself, and you get a market that's moving up. But before we put the cart before the horse, don't front run this. Wait to see if some of these signals are taken out, meaning can you get above that 8 at all and close the daily bar above? Can you get above the 21 and hold this trend line? Because if not, if this just keeps dribbling this way, then it's constantly every day lower is increasing the odds that you're going to revisit these lows at some point. So far, we're not seeing that, but certainly that is what that would imply. All right, let's take a quick look at NDX daily. And as I've been saying in these videos, slightly different picture in that we're close to the downtrend right here. The uptrend here is kind of the same. These two lows are not equal in that the NDX was weaker here on the pullback low there, so not equal. I guess it's probably the trend line, I guess, on Thursday, right? Wednesday that we're supporting, that's causing the bounce here on NQs. But again, they haven't done much, right? Like Friday's an inside day, completely inside. And again, where are the 821s? Right here, 8 going sideways, 21 here. And will you break trend and dribble down lower and put this into play or not? That's basically the big question for this week. So this week actually could be kind of pivotal, I think, from a technical analysis perspective, in that we're just riding that uptrend line, just kind of sitting on it. I think the NDX has held it better, as you can see, right? In the prior chart that I showed you, the S&P is already dipping below that line a little bit. But again, it's all the same, 821 sideways. Are we going to lose that trend or not? And will the market catch some footing here to put in that higher low and sort of kick things off back to the upside or not? Okay, on to our lead story this evening, which is what is stagflation? So let's just define stagflation in its simplest terms. We're not going to get too deep in the weeds. You know, I like to keep it simple. I certainly am not an economist by any means, but these are some things that we should know if indeed it does come on the horizon that we get this sort of environment of what type of market we could have in the future. So first things first, I noticed that there has been a Google trend here of searches over the last week. This is just the past 7 days. And you can see the rise in the number of searches for the term stagflation. And I kind of have been seeing that myself. I haven't been searching for it myself, but I've been noticing this term kind of creeping up a lot more and more. And that's why I decided to talk about it in today's video. So that being said, what exactly is stagflation? Let's go to our next slide here. Stagflation is defined by basically 3 things. And the name itself, stagflation, was coined by a British economist some time ago, I believe in the 60s. And it's essentially just a portmanteau of of stagnation and inflation. Portmanteau is just a fancy word for taking 2 words and just smashing them together, basically. So you just take stagnant and you mash it together with inflation and you get stagflation. And so you get basically a situation where there is stagnant growth. That means that GDP is going to be flat, and high inflation, and high unemployment. When you put these things together, that's the environment of stagflation. And in general, stocks don't like this. Just keep that in mind. Doesn't mean that they will all crash. They're just kind of going to go nowhere in there. So there's a couple of reasons as to why this occurs. One of them is a supply shock, and that's what caused the last stagflationary environment that everybody kind of remembers. This is a little bit before my time, but not that much, which was oil in the 70s, right, if you recall. And we were in this stagflationary environment for some time. But the other one is bad economic policy. Bad economic policy can also cause stagflation, and that is what I think is happening right now. Like right now we have a lot of bad economic policy, and I have to be very specific and careful here to tell you that these are not political statements at all. Okay, I never really go down that route purposely. What I'm about to say are just straight facts in the context of what's going on currently, and these economic policies that are happening right now vis-a-vis these tariffs are basically based on 3 premises, all of which are false. And those 3 premises are: 1, that tariffs are paid by exporting countries, meaning that it doesn't hurt American consumers, but this is absolutely false. All tariffs are always paid by importers, no matter what. If you want to import a good that has a tariff on it from an opposing country, you as the importer will pay that tariff at the port. They call that the duty or whatever. You will pay it in order to get your goods released and be able to take them home and take them, off the boat or whatever from the port. That money will go into the U.S. Treasury's coffers. However, it will be the importer that pays it, certainly not that country out there, such as China or whomever, that you got the goods from. And of course, that leads you to the next point, which is, what do you think the importer is going to do? Work for free, make less money? Hardly. They're going to pass that on to the consumer, and that's just basically how it is, right? That always happens no matter what. I pulled up this little thing right here. It was literally the first thing that I pulled up on Google. It took me about 2 seconds, and the first thing that came up was this tax foundation. I've always known this to be fact, but if you don't believe me, you can just look it up on Google and you can clearly see who pays tariffs. Americans will bear the cost. And if you go down through here, it just says over and over basically that the economic burden of tariffs will fall on others besides the business paying the tax, which means that it's going to fall basically on the consumer. And you have all these economists here that are basically just saying the same thing, that they found that in talking about, for instance, washing machines, solar panels, aluminum, steel, U.S. firms and final consumers bore the entire burden of tariffs and estimated a net loss to the U.S. economy of $16 billion. And it just goes on and on. It's just all these different examples of how basically the consumer ends up paying this. So that's point number one, in that this is a false premise here. Trade imbalances are bad is the next false premise. Basically, trade imbalances are just the way things work in a global environment when all countries are trading with each other, and it is not a bad thing. I could give you a million examples. An easy one would be to look at the situation between us and Vietnam, Cambodia, countries like that have been manufacturing cheap clothing for our consumption for a long time. We may have a trade imbalance there, but the bottom line is they sell us sneakers and t-shirts, and we sell iPhones and software and things like that. So you have to ask yourself the question, which country would you rather be? I think I'd rather be the one selling the software and the iPhones. And lastly, that losing manufacturing jobs is a problem. It would be if it caused the economy to contract. If all the activity that happened, in the 50s and 60s when we had such a big economic engine here from manufacture. If all that just went away and wasn't replaced, then it would be a major problem. But all manufacturing in this country has been replaced and then some, right? Because the economy has obviously grown all these years. It's all been replaced by a more services-oriented economy, right? We now sell more services as opposed to specific goods and software, tech, etc., and all that stuff. And that has been extremely robust for us. So that's the thing, is that losing manufacturing jobs is not really a problem. And obviously we all know that trying to put tariffs out to reshore those jobs is not going to work. It might work just a tiny bit, but that sort of thing would take probably decades in order to happen. We don't have the number of people required for it. We don't have the know-how for it, and we certainly don't have the resources for it, right? A lot of these things require resources that are coming from other countries, and that's why we need sort of a more free trade environment to do that. So basically that's the other thing that, that's the third thing here that I think is an absolute false premise, and that's why I believe that this is bad economic policy, and it is one of the things that can generally lead to a stagflationary environment. So that being said, who are going to be the winners and losers in such an environment? Going forward, gold is going to be pretty good. That generally will be a winner, and I need to put this in green. Commodities as well. Real estate, I put a little bit of a question mark, although really in an inflationary environment, it will rise as well. But I said specifically that rental REITs will probably do very well. If you think about it, right, rental REITs are going to do well. Inflation will move up, and that will benefit them in terms of, cost increases, etc. But losers will be consumer discretionary and tech. And keep that in mind, that we may see some sort of just like a long winter here in tech stocks. Like a lot of the stuff that we've come to depend on, pushing a lot of the growth of the U.S. market may not be the engine of it going forward, because if we are in such an environment, I would expect that technology stocks will probably decline. They don't tend to do well in that type of environment. So keep that all in mind. So that's my 2 cents on stagflation. I think the bottom line here is that I nor anyone else really know whether or not we are headed for this environment, but I always like to be looking forward in these videos and just give you things to think about, basically, right? Especially if you're a longer term investor. I think if you're a shorter term trader, it doesn't matter so much, although it does matter in that if we do go into an extended period, which, by the way, I do not believe would be as long as the entire 70s. I think that was kind of an extreme time, and things are certainly different now, and there's more inputs into the equation, etc. We probably would not have a situation like that. But what if there is a flat market for a year or 2 years? It could certainly happen where things just kind of go nowhere. We don't yet know the full-on effects of this policy, right? This stuff takes a little bit of time to kind of work into the system, and some of it has been paused. The situation with China is still very tenuous. There's still that sort of tit for tat. We don't know if that negotiation is ever going to happen or if they're going to resolve and eventually come down to some flat number like between the two that the consumer will be okay with and won't really disrupt things too much. That obviously would probably be the best case scenario, in that, you know, everybody sort of quote unquote wins. I put big quote marks in that, but you know, we shall see. All right, so keep this in mind. That's a situation with stagflation, and again, just keep kind of an eye out for it, and we'll see if things actually develop in that direction or not. Okay, time now for our number one draft pick. This is where I leave you with a specific stock that I think could be in play the next week with a trade idea. And this one is not really a specific trade idea. It's more something that you need to have on your radar, and it is a potential trade idea. But I will tell you this, there's probably a 99% chance that I do this trade next week. And we are talking about Netflix specifically because they just reported earnings this evening after the bell. And you can see that they are gapping up currently about 25 points, 973. So about, 25 points. The bid right here is 1,002 after hours. And that's going to put the stock right in here where we had some resistance before. And also this breakout level right here. So this is a very, very interesting area. So first things first, over that 1,000 level, there is potential that the stock rallies early. So play number one is going to be that you will buy either the first 1 minute high for a day trade, or you will buy the first 5 minute high, both for a day trade, and see how far you can run it if it goes, right? A little bit of an advanced play, I will say, not that easy, easier said than done, but those of you that are skilled in day trading, you know exactly what I'm talking about. The other play, which is the one that I will definitely be doing, is that you want to be looking at selling calls in this name. I've been talking for a long time and doing this trade probably for the last 2 years. Not so much in 2025. It hasn't set up that much, but in 2023 and 2024, in my weekly options room, I repeated this trade in Netflix over and over, which was essentially to be net short calls, meaning that I would put on a spread like a 1x2 or a 1x3 or an unbalanced call butterfly, all of which put me net short calls, meaning that I was actually short more calls than I was long. My preferred structure for this is a 1x3. So you can imagine like a structure would be like buy 1 here at somewhere like 1020, 1030, and sell, say, 3 up here. Somewhere at 1100. Now you're not going to be able to get it that wide. It's going to price out that way now, and I'll show you why, specifically only because all of this implied volatility is still here, even though it's that second week. Like this is the implied vol, or rather this is what we just finished happening right here, which would be the earnings right here. And you can see obviously how huge this is. This is obviously not normal or sustainable. And I don't even know if that's real. I don't think it was 1,000%. I think that's just kind of showing that after hours. But notice that even here into next week, it is still a bit elevated compared to the others behind it. And usually the way this works is that that will stay elevated early into the Monday session, but you need to be nimble. There will be a time to sell these calls, and it will probably be early. If the stock rallies all day, you'll get a little bit of a bigger window, but you can be sure that some of these premiums that you see very high up, like 1,200, whatever, it's just due to that IV, and these won't be here that long. I mean, look at how this call premium goes all the way up to 1,220, which is really nonsense. The stock's not going there next week. It's not going to rally 20%. So for example, I put here like a 1x3 of a 1030, 1100, which you could receive a credit for. And this will naturally expand in your favor as time goes by. If the stock rallies, it will really expand in your favor. This is a trade, as I said, that I've put on many, many times with my advisors in my own account over and over. And basically you put it on for a credit and you take it off for a larger credit. And there's just something about the nature of Netflix calls. There's always kind of this skew to the upside where those calls are relatively rich, and it just works really, really well. And we've done the trade over and over, as I was saying. But again, this is all going to move and shift, and a lot of this IV is going to come out Monday morning. You're certainly not going to get probably 70 wide for a credit, but you're going to pick your spots accordingly. And maybe you're going to be able to get 30 wide or something like that on a 1x3. Okay, so just keep that in mind. Now, obviously, there's upside risk, there's danger to the trade, that being said, but it's relatively easy to manage because you've got short calls way, way out of the money, and you can always roll them. And you remember, if you're in a 1x3 structure, you certainly don't need to roll them all. You'll probably just need to be rolling one unit out of that three. So you'll leave yourself with a 1x2 trade, which will trade for huge credit to your benefit and just push those other ones away. We've almost, I think, never had to do that at Netflix. We've been pretty good with this. We haven't had to roll at all. Maybe we did a couple times, I don't remember, but certainly never really got in any trouble that would bring upon a losing trade. So that's what I'm going to be looking for in Netflix next week, exploiting some of this IV that I think is still there. I want to see early how it does. It's a potential day trade, I think, holding above that 1,000 level because it's a key level as I showed you on the chart. But then again, also behind that, think about what you can do on the call side in terms of being net short calls and be a seller of the calls as the stock moves up, preferably, as I was talking about, with the structure of having a long call in front of those short calls. And I think you'll see that it's going to work out really well to your benefit. All right, time now for a little looking ahead to give us an idea of what's coming down the pipe next week as far as economic data and earnings. We are now in the middle of earnings season, so this is important. Remember, this is just a very small smattering of what's going on, stuff that I'm paying attention to. Economic data, nothing out of the ordinary, quiet on Monday, which it often is. New home sales on Tuesday. And then Thursday is the usual initial claims, continuing claims is always on a Thursday. But we're also going to get existing home sales on Thursday. Again, I only talk about that economic data, which is of high impact. Nothing on Friday. And earnings. So stuff that could move the market or be tradable. GE on Tuesday. Also Verizon in the communication space. That's XLC, which is one of the 11 sectors in the S&P. And Tesla. That's an important one because it is a very big component of the XLY, which is consumer discretionary, and that's very, very important. That's, of course, a decently sized part of the S&P as well, so keep that in mind. Tesla earnings, and that's always a fun one to trade after. We'll see. That stock has been in a relatively large range, right? You can kind of look at that box. We've looked at that in past videos, and I'm very curious to see if these earnings push it outside of that box, above or below, and if so, I think there could be a larger trade to be had. All right, Wednesday brings us Boeing, Chipotle, one of my favorites, the product, not really the stock, but IBM in the tech space, and also Texas Instruments, all of which are important. Merck in the pharmaceutical space on Thursday, and Google is very, very important on Thursday. They've got some antitrust stuff happening right now that does not look like it's going well in their favor. So we'll see if that ends up being a problem for them or not. But regardless, they're going to report results on Thursday. And that is your looking ahead for next week. And that's my show for today. Thank you so much for hanging out with me on this weekend edition. Good to have you as always. Let's recap a little bit of what we discussed. We had a long discussion on the dangers of potential stagflation. We're certainly not there yet, but just kind of looking ahead as to a potential outcome for the economy and the market given the current economic policy, because specifically that policy does create all of the three inputs into stagflation, right? We already know that it is inflationary if these tariffs stay the same. It will create higher unemployment and it will lead to stagnant growth. And those are the three inputs into stagflation. So if we don't get some sort of resolve on this front, that's probably where we're headed over time. So just be aware of that. Chart-wise, what this is playing out to right now is just a lot of chop right now, as I think everybody's just kind of waiting for the next headline to drop. But remember, that could be the wall of worry that stocks like to climb. But if so, me personally, I need to see a little bit more confirmation. We're now underneath that 8 EMA. We're sitting right on that trend line, maybe a little bit below in the S&P, right on it in the NASDAQ. So it's really kind of this no man's land. So I'm very happy right now to just be short some gold puts, looking forward to doing something on that Netflix on the call side. But outside of that, not a heck of a lot going on until I see a stronger signal. So I think you should probably do the same. This is not a good environment for the, sort of 2 to 5 day, 1 week, weekly options trader outlook. I've been holding my own, as you can see by the performance, but it's not easy out there. And that being said, come and join me if you can. ShadowTrader.net/options. At this point, having been doing this so many years, I know, I hate to say it, I probably shouldn't say this, but I pretty much guarantee you that I will make you money, but that's not what's important, because what I absolutely can guarantee without any shadow of doubt is that I'm going to make you a better trader, I'm going to make you more astute in terms of reading price action, and I guarantee you, you are going to understand how price action works better than you ever had before. So come and join me at the link below, $7 1-week trial, shadowtrader.net/options. And you, my friend, will be drinking from the fire hose. All right. Anyway, Netflix next week could be interesting. Again, above that 1,000. So I'm looking at that. Beyond that, again, just be careful out there. Not a lot going on. Look for those signposts. See if we can get a move up. If you can, most importantly, please hit the like and subscribe buttons, especially the subscribe button, because I don't know if you've noticed, we are now about 700 or 800 subscribers away from the 100,000 mark, which is super exciting. We've been looking forward to this for a long time, so hopefully YouTube will send us that plaque or whatever, but maybe we crossed that line this week. Again, we're very excited about that. So if you're not yet subscribed to the channel, if you could help us out, hit the little button down below. All right, that's all for this week. Coming at you as always from beautiful Los Angeles, California. I wish you good trading and good night.